Welcome to Learn Wealth, your go-to channel for real estate insights, market charts, and golden opportunity.
Hey everyone, welcome back to the channel. It's Monday, and that means it's time for another market update. Today, we've got a packed agenda. Fed rate cuts, stock market movers, gold reaction to rate cuts, bull steepening of the yield curve, commercial real estate, and problems in the retail industry. My name is James Santiago, and you're watching your show, Learn Wealthy. Let's break it down. The stock market. So the Fed just cut rates, and everyone's been asking, how's the stock market reacting to the rate cut? Well, after the 50 basis point cut on September 18 by the Fed, the next day, September 19, the major indexes shot up. The S&P shot up from 5,625 to 5,725, then started trending down again. NASDAQ shot up from about 17,600 to above 18,000, then started trending down again. And Dow, the DJI, shot up from 41,500 to about 42,000, then went flat. FedEx Corp is down by 15.23% by the weekend due to a combination of factors. Weaker earnings outlook. FedEx's recent earnings reports have shown weaker than expected performance, particularly in its Express division, which is heavily impacted by declining package volumes. Slower global economic growth has reduced demand for shipping services, and FedEx is feeling a pinch. Cost-cutting concerns. While FedEx has implemented cost-cutting measures to mitigate the decline in demand, investors worry that these cuts might not be enough to offset the slowdown. Additionally, reducing costs in key areas could limit the company's capacity to grow or adapt to market changes. Macroeconomic headwinds. The global economic environment has been challenging, with persistent inflation and higher interest rates impacting consumers and business spending. FedEx, as a logistics company, is sensitive to these economic shifts because when consumers' demand slows, so does shipping volume. Competition. FedEx faces intense competition from both global and domestic carriers like UPS, as well as tech-driven logistics companies like Amazon, which is increasingly building its own delivery network. Increased competition can put downward pressure on FedEx's pricing power and market share. Many public companies are not in good shape, where either stock prices or earnings have dipped. Some examples are Home Depot, McDonald's, Dollar General, and many more. But isn't everybody saying, as soon as the Fed cut rates, the stock market will be hot again, and the economy is going to be great? They got it all backwards. Why would the Fed cut rates in the first place if the economy is doing great? Do you know what other time in history did the Fed also cut at 50 basis points? And also at September 18 during the GFC, the Great Financial Crisis. Here are the breakdown of the rate cuts the Fed did during the GFC. GFC rate cuts. Starting with September 18, 2007. The Fed cut rate by 50 basis points, with Fed funds rate from 5.25% to 4.75%. The reason? Early signs of trouble in housing and credit markets, particularly with subprime mortgages. October 31, 2007, the Fed cut rates by 25 basis points. Rates went from 4.75% to 4.5%. Reason? Continued deterioration in the housing market and weakening economic growth. December 11, 2007, the Fed cut rates by 25 basis points. The rate went from 4.5% to 4.25%. The reason? Further concerns about the credit markets and weakening economic indicators. January 22, 2008, there was an emergency rate cut of 75 basis points. The rate fell from 4.25% to 3.5%. The reason? Emergency response to increased global financial instability, stock market turbulence, and recession fears. January 30, 2008, the Fed cut another 50 basis points, and rates fell from 3.5% to 3% for ongoing concerns about recession risks and financial stress. On March 18, 2008, the Fed cut another 75 basis points that dropped rates from 3% to 2.25%. This is a response by the Fed to deepening financial turmoil, especially after the collapse of Bear Stearns. Fast forward to April 30, 2008, another 25 basis points was cut, the rate fell from 2.25% to 2%. The reason? Further signs of economic slowdown and financial stress. October 8, 2008, emergency cut of another 50 basis points, which made rates fall from 2% to 1.5%. The reason? Coordinated global central bank action after the Lehman Brothers collapse and escalating financial crisis. On October 29, 2008, another cut of 50 basis points that made rates fall from 1.5% to 1%. The reason is escalating concerns about the global financial system and a deepening US recession. And on December 16, 2008, another 75 basis point rate cut, and the rates fell from 1% to a range of about 0% to 25%. The reason? Severe financial crisis and collapsing economy. This brought the Fed funds rate to a near zero, where it remained for several years. The Federal Reserve cut rates from 5.25% in September 18, 2007 to a rate of nearly 0% by December 2008, a massive reduction of over 500 basis points or 5% in just over a year. It just shows that when there is enough systemic risk in the global economy and in the euro-dollar system, no amount of Fed rate cuts can save the people. Just before all these rate cuts happened in 2007, the 2-year and 10-year yield curve inverted, just like today. The SOM rule triggered, just like today. The Buffett indicator was showing a stock market bubble, just like today. The personal savings rate was down, just like today. Real estate was in a historical bubble and gave signs of major trouble in the industry, just like today. That is why my base case is the Fed will have further rate cuts as we go towards the end of the year, and it will not be able to stop what the yield curve has been warning us for 2 years. Quoting George Gammon from Rebel Capitalist, there are no certainties, only probabilities. You can argue that they did cut rates during 2020 and it did save the day. However, the stock market did crash and the unemployment was crazy. But I would argue that this is a special case due to they forced everyone to be locked up in a cage like animals. Inflation was kind of high right before the GFC at 3.8%. But before the 2020 crash, inflation was 1.2%, which was almost nothing, just like the Orange Man said. Arguably, real estate would have crashed too if they didn't impose all the moratoriums that bailed people from being foreclosed or being evicted, and if the Fed didn't increase money supply by 30%, which was good for some people, but also had its consequences that we faced inflation of 9%, 8% years after. And those consequences have stayed with us until now. Also, the fact that mortgages were 2% at the time, while helicopter money was freely given, really increased real estate demand and created the real estate bubble that we're in today. You can't say the same that real estate is gonna do the same thing today. Like I said, if you watch my previous video, the Fed cutting rates will not necessarily bring mortgage rates down because mortgage rates follow the 10-year treasury and not the Fed funds rate. The Fed fund rate actually follows the 2-year treasury. Besides, if we happen to be in a 2% mortgage rate again, it will not just encourage buying like it did back in 2020. This time, it will also encourage selling from all the homeowners with golden handcuffs with 2% rates that have been itching to sell as soon as buyers can buy again. Gold's reaction to rate cuts. Gold, now here's something that always stirs up interest after a Fed decision. It's been doing its thing as a safe haven, with gold prices rising slightly after the rate cut. Investors are hedging against what they see as future inflation risk. We've seen another all-time high with gold at around $2,629 per ounce. Commercial real estate in the US. Now, commercial real estate is where things get a little dicey. With a rate cut, borrowing costs are lower, but the sector is still grappling with high vacancy rates, especially in office spaces. Major cities like San Francisco and New York are seeing a rise in ghost offices as remote work continues to dominate. We're also hearing whispers of distress in retail real estate as retail businesses collapse, such as the Dollar General. Shares have been falling from around $250 per share to just about $80 per share as they've been declining for the past months. Dollar General hold the most store branches in the US as it operates over 19,000 locations across the country, surpassing 7-Eleven, CVS, Walgreens, and Walmart in terms of number of store locations. No matter how big they are, this business model is done, in my opinion, as they can't even sell anything for $1 anymore. People with low income are supposed to go here when they can't afford to buy things from other places. But now, Dollar General can't even afford to price their products cheap due to inflation. In a true free market capitalism, businesses are not in favor of inflation. That is why they can't just price gouge. With inflation, their margins get thin as the wholesale cost of their products gets expensive too. While having high costs to produce the goods they provide to consumers, they still need to compete with businesses and lower their prices, and it's just not gonna work out for them. Bond market and the 2-year, 10-year bull steepener. Over in the bond market, we're seeing a bull steepener with a 2-year and 10-year treasury spread. What that means is the short-term rates are falling faster than the long-term rate, which typically happens when investors expect lower growth but less immediate risk. The recent rate cut has played a role here, as it made the short-term borrowing cost even lower. It's a classic risk-off move that signals investors are hedging for tougher times ahead. So to sum it all up, the mainstream media is optimistic that the rate cuts will be good for the stock market, but history says the opposite. Gold is holding strong, commercial real estate is still in a rough patch, and the bond market is signaling a systemic risk, not just in the US, but in the global economy. Add in a dash of geopolitical uncertainty in the coming election, and we've got a lot of future Learn Wealthy content ahead of us. Thanks for tuning in on this week's Monday Market Update. If you enjoyed this video, don't forget to hit the like button, and it will really help me make these videos better. Please subscribe to Learn Wealthy for more finance, investing, real estate, and macroeconomics. I'll see you in the next video.